Hello and welcome to our financial awareness presentation. My name is Chris Bottrell. I'm the Operations Director and a practicing IFA with the business Uniec Prestige Limited. So, a bit of background about our business. You probably wouldn't gather from how we spell the business name that we pronounce it Uniec Prestige Limited. The name was formed from those words, union and employee consulting. Myself and co-directors, well, we've known each other for some 20 years now and shared a common view that within the workplace it is extremely difficult to get impartial financial advice. And that led us to form relationships with a variety of organisations, outplacement companies, industrial unions, amongst others. And that saw us take our services across the whole of the UK into businesses to provide that type of support and advice. Over the years, we've been extremely privileged to work with lots of different businesses of all types across the UK. And to date, we've worked with well over 180 different businesses across the country. You may find it of interest that amongst these there are financial services providers calling upon our services, institutions who have advisors of their own. So why would they choose us? Well, we'll touch on that shortly. Before getting any further, it might just be worth explaining why we call these presentations financial awareness. If I was doing this in a live situation, I'd often ask the attendees who has never sought advice and why. And in some instances, that would attract a jovial comment and remark from some about, I haven't got any money and therefore don't need to seek advice. And of course, that perhaps can be valid in some circumstances. But if we thought about any other reasons people do not seek advice, I'm sure ranking right up there would be, who do I trust and what's it going to cost me? What's the benefit of this service going to be? There are probably two obvious reasons why people may not seek advice. But there is a third reason which is more obvious to us but may not be obvious to others. And this can be applied across a lot of areas of life, not just in the world of finances, in the saying that you don't know what you don't know. I.e., if people don't know enough about a particular subject matter, we may not even be able to see that we do need to go and get further information or seek advice. So the whole purpose of this financial awareness presentation is really focused on education. It's about raising people's knowledge so that you can then apply that in whatever way you wish to do so, to see if you do need to seek further guidance. And if you do, that service is available via us should you wish to engage with us. And towards the end of this presentation, I'll explain how that works in practice and give you a clear indication of what sort of costs may apply. But for now, we'll start to focus on savings, investment and tax. If you are going to seek advice, a good place to start would be to know exactly who you are talking to, because there are different types of service in this field. In the UK, we have restricted and independent advisors, and there are massive differences between the two different propositions. The best example of your restricted advisor are those people who work for banks and building societies. They will often be tied to offering services from a single or limited range of product providers. So, for example, if you've received a lump sum, you've got some money to invest. If you do your banking with Lloyds, you are likely to be put into a product run by Scottish Widows. If you do your banking with Nationwide, it's likely to be Legal & General. And if you do your banking with NatWest, it's likely to be Aviva. Whereas independent advisors have no such ties or restrictions. They are whole-of-market advisors. There's also a difference regarding the costs and charges you'll expect to pay. Those working as restricted advisors can earn commissions from the products and services they sell. Independent advisors, however, cannot. For investment advice, they have to be paid by fees, and those fees have to be mutually agreed in advance of them being charged. So there's complete transparency. It also takes away any potential conflict over bias towards particular products and services. Also, there's areas of specialism, such as defined benefit transfers. You won't get advice of that type of specialism through restricted advisor channels. There are certain areas you've got to be independent to give that type of advice. And with that specialism, you do need specialist qualifications, and I personally do hold the latest defined benefit transfer specialist qualification. It is because of our independent nature, our impartial nature, which may be the reasons why some financial service providers choose to use our services as opposed to their own. If you are going to invest some of your hard-earned money, there's a number of concepts to grasp towards getting it right, and I can't emphasise enough the need to look at diversification. If you'll bear with me with this chart, I appreciate it's a massive colour. We've got a number of years going left to right along the bottom of the chart, and along the right-hand side is a colour-coded key. Now, each one of these colours, with exception to the dark blue, represents a type of asset you could invest your money in. This chart represents a sample of assets, not all assets. If we covered all assets, the chart just would not be readable, and it's bad enough as it is now, I might say. But at the top of each column, we've got the best performing of those assets, and at the bottom, the worst. Now, you could pick any one of those colours, any one of those assets, and follow that across the screen from left to right. And not only will you see yourself jumping up and down like a yo-yo as you bounce across that chart, you'll also notice the differences in performance. Now, would you want that sort of experience with your investment? I very much doubt it. The idea of diversification, which is expressed by the dark blue boxes in this chart, which represents a diverse portfolio, is that by investing in lots of different things, you can remove some of the volatility, and volatility means the differences between the highs and the lows of investing. So as you as an investor will experience a much smoother ride with regards to the returns and the experience you have with your finances. Yes, you still have good years. Yes, you'll still have bad years and not so good years, and so on and so on. But as you can see, the difference falls somewhere around the middle in returns-wise, as opposed to being all over the place. And diversification really is a fundamental thing behind any form of investment strategy. To further emphasise the value of independence, if you were to invest some of your hard-earned money, I'm sure you'd want the confidence of knowing you're investing it somewhere where you're going to get value for money, i.e. a decent return for the risk that you're prepared to take. The way the industry helps people like us compare different service propositions is by grouping them together in sectors. And this chart represents one sector, which we'll call the mixed asset 40 to 85% shares sector, which was previously known as the balanced managed sector. The reason I've chosen this particular sector for this slide is that with pension schemes through the workplace, if you don't make your own investment decisions when investing into those schemes, usually there is a default investment route that's decided for you. And usually that would fall into this sector, if not now, certainly at some point. And as a result, there's 915 pension funds within this sector over the last 5 years, run by all the various insurance companies and so forth, and pension companies that you could be invested in. And this shows us the performance of £10,000 over 5 years. We have the worst of them turning your 10,000 into a loss of 7,500, and the best turning it into a gain of over 16,000. So a loss of 25%, a gain of over 60%. 85% difference in the level of returns between the worst to the best. And of course, if you're talking to somebody who's restricted and only can offer you what they've got, you're not necessarily going to get access to what's doing well. It doesn't mean to say what's doing well now will do well in the future. That's, nobody can predict future performance. But what data like this does give us information around is the quality of the decision making and the fund management that's going on in the background, so that when independent advisors are looking at products and services for people to be investing money in, then we're looking for those services that are tried and tested and got good positive data behind the proposition. And I'm sure that's where most would want to be applying their hard-earned money. And of course, if you are going to invest money with any form of investing, there is risk. And risk can be measured in lots of different ways. For example, if we just leave our money in the bank, it might be nice to see we've got that money there in the bank, and it'll be there next year and the year after that. But if all we're earning is 0.5% a year in interest, if you're lucky, well, inflation's stripping the value of your money. So keeping money in the bank means you've got inflation-related risks. And over the course of the long time, of course, that isn't really going to do yourself justice with your finances. So if we are going to invest money, we need to ask ourselves, well, why are we investing? How long are we looking to invest for? There is a concept that the longer the time horizon, technically, the more risk one could afford to absorb. For example, if you're 20, you're 30 years old, you're saving for your retirement, which is going to be 30, 40 years or so away, then why not afford to take high risks now if you're comfortable with that? But of course, if you are about to retire, i.e. you are, say, within 2-3 years of retirement, could you really afford to absorb high losses and high risks at a critical time as to when you need the money? So that's what we mean by time horizons. What are your investment objectives? Why are you investing? We need to have a conversation around risk and understand what you feel comfortable with, or as I prefer to put it, what you don't feel comfortable with. So we therefore need to understand and establish, exactly how do you feel about taking risks? What timescales are involved? What can you afford to invest, taking into account what you need money for within the foreseeable future? We need to understand your capacity to withstand losses. Now, obviously, nobody likes to incur losses. That isn't the long-term purpose of investing money. We're doing it to get a better return. But the whole concept of investing revolves around the ability to accept the potential for losses in the hope for better returns over the longer term. So there has to be a willingness to accept some scale of loss at some point throughout the course of investing. But how much could you afford to lose before it starts to affect your livelihood or affects your future plans? So we need to quantify this in some way. And only when we've been through a robust process of analysing and understanding what your investment objectives are, the time horizons, what and how you would feel, what would happen, how you would feel in certain circumstances if losses were to occur, only then can you start to understand that firstly investment is right for you, and you can do so with a degree of confidence. But what's more important than anything else, if you are going to invest money, you need to be able to take a medium to long-term view. And by that, we'd always consider a minimum of 5 years. And because of that, it's really, really important to make sure that before you do invest money, you've given consideration to any financial needs within the shorter term, and that adequate monies are set aside in secure forms to cover those particular needs. So what are we doing when we invest money? Well, we're buying assets. That's what we're doing. We talked about different types of assets in that multicoloured chart earlier on. And an asset, of course, has a value. And the hope is that over the course of time, the value of that asset will appreciate in value, which then in turn generates your investment return, along with any other income that may be generated through the form of dividends, for example, which, if not paid out as income, is rolled back into the investment to contribute towards the returns. And of course, investing in assets, given the vast number of different types of assets there are out there, well, that allows us to build diverse portfolio by investing in lots of different assets at any particular time, and so on and so on. But of course, there are some disadvantages. The risks and the returns might not be what you expect. There will be charges to pay, and charges for investing, of course, will reduce the returns. It's impossible to predict when is a good time and when is a bad time to invest. And there are limits on the amount you can invest tax efficiently. So, to a partial summary around this section and some important points to think about. I'm sure if I asked you all, do you like paying tax? I'm sure the common response would be a resounding no. Tax evasion is highly illegal, of course. Please don't get involved in any of that sort of thing. But sound, proper tax planning and making use of your tax allowances is surely a sensible thing to do. We, of course, are most likely to be aware of the annual ISA allowance, the fact you can invest money each year tax-free. We can pay into pensions and claim tax relief. We can claim £1,000 per annum in interest earned on savings accounts tax-free, albeit given the current interest rates, one needs quite a lot of money in the bank to earn £1,000. There are also other allowances, capital gains tax, the personal allowance, for example. That's the amount of income you can earn tax-free each year before you start to pay tax. And if you are a married couple or in a civil partnership, you can, of course, claim 10% of the other spouse's allowance if they're not using it fully themselves, which in turn means you can save a bit of income tax on your income. And often with some of these allowances, if they're not used in the current tax year, they go foregone. Asset allocation and spread of risk I've just talked to death over really, but I'm throwing it in there again just to place additional emphasis upon it. Then we come to regular reviews. With all the sound planning you can put in place today, that does not necessarily mean that given 5-10 years from now, it will still remain fit for purpose. There could be changes to your circumstances, there will certainly be changes to legislation, product design and so forth. So keeping on top of things does become really important. More so than not with your retirement provisions, if you think you could be saving for retirement over a period of 30, 40 years maybe, and then when you get there, those funds could be there to use for the rest of your life, well, keeping on top of your retirement savings becomes important. Often, because people probably lack a bit of understanding in these areas, well, you tell me, what happens when your statements come in? Do you read them? Do you understand them? Do they go straight in the drawer? Do we ignore the position because we're not retiring today? And so on. Maybe, maybe not. But I'll talk more about that in the retirement section. But because of that, we do meet a lot of people who've never reviewed their retirement savings for, say, since they were taken out, and there could be benefits of doing so. Things you could do to improve your retirement provisions now before it's too late. And then I'm going to throw a couple of one-liners in here. I've already spoken a bit about making a will, but also about long-term care planning, simply because we know there's things you can do legally now to protect the value of your house, your assets, your savings from the local authorities if you do go into a care home or need care in your home at some future point. But of course, the key to getting this all sorted out is to get it done sooner before the event could even possibly arise. For those who it may apply to, it's probably worth just focusing 3 or 4 minutes on severance pay and how it's taxed. You may be aware the first £30,000 is tax exempt and the balance then added to your taxable income for that year. So if the taxable amount, i.e. everything above £30,000, is taking you into high rate taxpayer brackets, or if you're already a high rate taxpayer, then of course you will pay high rate tax upon that. There are other complications as well for those high earners or people with high severance pay if the total taxable amount takes you above £100,000 for the year, because then you start eroding the personal allowance. One difficult aspect of this, though, is understanding how the tax is actually applied, because it is not as straightforward as it may seem. With being taxed through the PAYE system, it's taxed under what we refer to as month one rules, i.e. the amount you receive in a particular month will be aggregated over the rest of the tax year and added to other income to date. So it could see you actually having a significantly higher amount of tax deducted than you actually are required to pay. That's why there is a form, an HMRC form called P50, which you can download off the internet, fill in, send to HMRC and negotiate an immediate tax refund if they will do that. There are ways to offset the tax on severance pay, such as paying the money into pensions. There are, however, a set of considerations here relative to your age. Of course, if you are over the age of 55, you could pay money into a pension, claim that tax back, and you've got immediate access to that pot of money. But if you're below the age of 55, then of course you haven't. And consideration then has to be given to tying that money up for that period of time, depending on your age. That could also interfere with other considerations, especially amongst younger people, where you may have mortgages still to pay, other debts outstanding, and with needing to get other employment, you might be considering the options of paying money into a pension to save the tax and reclaim the tax versus probably more important and pressing needs to repay other things. That is a conversation for an individual basis to weigh up the pros and cons. And of course there are other areas you can invest money to offset tax. However, these tend to be more specialist investment vehicles carrying a higher degree of risk, which may not necessarily be suitable for some people. So you can see with tax on severance pay and the various options around what do you do with your severance pay, how do you invest it, where do you invest it, do you offset the tax? There's a lot of things to consider, a lot of pros and cons. And I'd also just throw a word about the timing of doing this sort of thing. Some of the timing may be governed by where you are in the tax year, of course, if you are looking to mitigate tax. But some issues around timing also need to relate to when you find yourself new employment, if that's the case. For example, do you want to rush to pay off debt if suddenly 6 months down the line in a new job you find you don't like the job, or the employer decides you're not fit for that role, that it's just not a suitable match? If you've rushed to pay off debt and you've no longer got access to that money, you might regret doing that. So just be mindful of the timing of when you do think about investing on paying debts off, just to make sure you are comfortable with what you are doing. Okay, so up to now we've had a look at the concept of investing and so forth. And the reason why we look at this first is because when we get onto the subject of pensions and retirement, there are, of course, different types of retirement savings, final salary schemes, etc., money purchase schemes. We'll have a look at those shortly. But for those who are in a severance situation and moving on to new employment, unless you're going to work in the public sector, it's highly unlikely you will have access to a final salary pension scheme. And it could also be likely that what you've been doing with your pensions up to this point has also involved some form of investment. So all of those concepts we've talked about up to this point apply here. The state pension massively changed over recent years. In 2016, a massive overhaul to how it all works. The current weekly rate for 35 years full national insurance record sits at £175 per week. But we need to look back into the history of the state pension to work out exactly what you were going to get. Under the old regime, for 35 years national insurance record, that would have qualified you for the basic state pension. And the current weekly amount of that is around about £130 per week. However, on top of that, under the old regime, you'd qualify for top-ups. That took the form of SERPs, which you may have heard of, State Earnings Related Pension Scheme, which was then replaced by the state second pension. Both of these benefits relate to what you earn. So therefore, if you've had a relatively modest income during your working life, your top-up would reflect that. However, if you've had a high income during your working life, your top-up would reflect that too. And for the high earners, it's not uncommon under the old regime to see people with a total state pension exceeding £200, £210 per week, where those individuals have been contracted in all of their working lives. And unfortunately, this is where we do need to bring a couple of bits of jargon in, contracted in and contracted out. If you are contracted in, all of your state pension benefits are provided for by the state. If you have contracted out, however, those top-ups, namely the SERPs, are provided by your employer scheme or a private pension scheme of your choice. If historically you've been a member of a defined benefit final salary scheme, that choice was made for you. You're automatically contracted out. So your state pension forecast, that's what you need to get online. And I'd advocate using the .gov.uk website for that, not the many businesses that come up in the Google search engine offering to do that for you. Obtain your pension forecast, and that will tell you what you have accrued to date. And if you've had years of being contracted out and therefore have a shortfall in your entitlement below the £175.20 a week, well, it will also tell you how many years you need to carry on contributing for in order to claw back, I suppose, to get to the £175 per week. Just quickly, whilst on the subject, because this is very, very complicated, your state pension forecast will give you all the insight you need as to see where you are. But just a word on pensions that you may have lost track or trace off over the years. There is a second government .gov.uk service, a pension tracing service, and that is a service you can use to try and track and trace old pensions you may have lost contact with. Again, please use the .gov.uk service and not the many businesses out there offering to do this service for you. There are lots of different types of pensions out there, all with funky names. Some may mean something to you, some may not. Some examples are flying onto the screen right now. But when all said and done, they do only fall into one of two categories. You also have, or may have, spouses, partners as well. And ultimately, when we're saving into retirement provisions, your provisions are there to provide a benefit for those you leave behind, and vice versa. Those of your spouse, partners, any savings they have are geared up to provide a benefit for you too. So as we talk about thinking about retirement savings and your various options, regardless of what age you are at, it really should be looked upon as a joint thing, and you might want to give consideration to any pension benefits that your other halves may have too. Regardless of all the fancy names associated with pensions, they do, as we say, fall into one of two categories. They are either defined benefit pension schemes or defined contribution pension schemes, and the names really purely define exactly what's going on here. Defined benefit means exactly that. We know in advance of your retirement, we have an idea of what the benefit's going to be, simply because what you'll receive income-wise is based on a mathematical formula. There's no investment risk involved on your part. It just is a pure mathematical calculation looking at your length of service, your salary, and what's referred to as the accrual rate of the scheme. Defined contribution means exactly that. All that we know here is what's being contributed. What you receive when you retire is anybody's guess. I haven't got a clue. There's too many variable factors involved. How much you pay in, how much your company pays in, what the investment performance is, what the charges are, what the legislation is when you get there, what you decide to do with the savings, how you intend to use them, whether you've got to provide for a spouse, and so on and so on. The variables are pretty much endless. Which is why it's always considered that the defined benefit pension schemes, because they are considered financially secure, i.e. you don't have to take any personal financial risk with them, other than be concerned if the business were to become insolvent, but I'll mention about that in a minute. Generally speaking, final salary schemes are secure. And because of that, they are considered the better scheme to be in, because we know in advance what your benefits are going to be. The Pension Protection Fund is there to protect schemes of this type should an employer become insolvent. I'm not going to go into detail about how the PPF works. You can Google that for yourself if you wish to find out the technical detail. But for those schemes that are eligible to be part of it, in the event of insolvency, the Pension Protection Fund aims to protect benefits for up to 90% of what you otherwise would have got, subject to certain rules, terms, conditions being met, and caps that may apply. But as I say, the details are available elsewhere. So what are your pension savings options? Well, if you're old enough, i.e. 55 and above, you can start to draw your benefits now. It is probable that if you draw them sooner than later, you may get less than what you would later on, but the ultimate test in that, of course, is it affordable? Lots and lots of people we meet will, well, for example, I might have a one-to-one with a 61-year-old, and the 61-year-old will say, I've got 4 years to go. And I'll say to that individual, why have you got 4 years to go? It's because this pension says I can retire at 65, and it's because my state pension is going to be payable at 65 or 66, as the case will be now. But two things need to be understood. How much have I got, and how much do I need? So for those people who are putting the state pension, not the state pensions, for those people who are putting their personal and company pension statements in the drawer, well, if you don't know what you've got, and you don't know what that's going to give you, whether that's today or at a future point, and you haven't worked out how much you need to live on, well, how can you possibly make a decision as to when you can afford to retire? And because of that, because of a lack of that knowledge, people, I find, tend to carry on with the default way of thinking of, I'm going to retire when I'm 65. Is that where you want to be? Maybe, maybe not. There are other decisions around it, the emotional decisions. Some people might like to retire at 55. Some people may not, may be worried about what will I do with my time, etc., etc. But if you are old enough to do so, you've got options to start drawing them. And if you do, what are your options? You don't have to draw all of your benefits today. You might need access to some now and leave the rest for later on. How might this work? Well, say, for example, somebody's gone through a divorce at some point in life, or has got to a point where, for whatever circumstances, there are debts and, still a mortgage to pay off through probably restarting following that divorce. Maybe you're not ready to finish work completely yet. Maybe you want to carry on working. Maybe just accessing some of your benefits out of your pensions could give you that financial breathing space to give you a better quality of life now, yet you're not totally trashing your future retirement prospects by accessing all of the money. You're leaving some of it for a future date. You can do that. Your existing pension provisions may not allow you to, but legislation says you could. And if there's things you want to do with your retirement savings that your current provisions won't allow, well, we simply need to consider doing something different with them. Do you do nothing? Because doing nothing is always an option to do. But what I would advocate, what we said earlier, if you are going to do nothing, make sure you're choosing to do nothing from an informed standing, i.e. you've understood what you've got and what's going on with your provisions, and doing nothing is the right thing to do rather than it be the default thing to do through a lack of understanding. Do you start transferring your benefits to another employer's scheme? Do you move them elsewhere? Do you think about self-investing if you're thinking of starting up your own business? Could you use the pension money to buy commercial property to trade from, for example? Because you can do that. But of course, if you are going to be thinking about doing different things with your retirement savings, that brings with it lots and lots of complications that have to be considered. And of course, if you are old enough to do so, there's lots of factors affecting how much you will get out of your retirement savings. If you don't want any financial risk whatsoever, all you can do is hand your savings to an insurance company who will give you a secure income for as long as you live. And there are lots of factors affecting how much income an insurance company will give you. Some of those are listed on the screen, but the way I'm going to explain it is by talking about two individuals. Let's call James and John, two individuals. What can I tell you about James? Well, James is married. His children are grown up, left the house. James is a pretty fit, healthy guy, never smoked, never drank, never lived, I suppose some might say. He does half marathons regularly, likes his fitness regime. He lives in the Cotswolds. He's worked in an office environment all of his working life. Now let's talk about John. What can I tell you about John? Well, John is single. John, as a result of that, does not have children. John lives in Glasgow. He's a smoker. He's a drinker. A few minor health issues for his age, bit of high blood pressure, high cholesterol. He's worked in heavy industry all of his working life. Everything I've said about John means, from an insurance company's point of view, he'll get more income out of his savings than James can ever possibly think to get. Why? Well, because John is a smoker, he can expect to get up to 30% more income than James. Because John lives in Glasgow, well, he can expect to get more income than James. Why? Because you're quite likely to die at an earlier age, believe it or not, in Glasgow than you are in the Cotswolds. James needs to think about providing a pension for his wife. John does not, because he is not married. All of these factors I've said about John, some of them affecting life expectancy, is why some insurance companies will give you more income. And then we come on to the subject of final salary schemes. Now, I stand by what I said earlier. Final salary pension schemes are considered a secure form of retirement savings, and they're not at your risk, they're at your employer's risk. They're also index-linked, which provides a form of inflation proofing. So for those reasons alone, they are considered the best type of pension scheme to have. There is, however, the concept of transfers, and one of the best times to look at this is when you are about to retire, because there is a way to make more direct comparisons rather than predict what a future outcome may look like, say 5, 10, 20 years from now. So I'm going to talk you through this example, but what I would say is, due to the security and the index-linked nature of the income that these schemes provide, giving that up is a very, very serious decision to make, given that, in addition, it's irreversible once the transfer's taken place. However, if we look at this example, I'll leave it open to you to decide what your opinion would be in respect of what you would do. But just to make this more real, I'll explain about the circumstances the individual in this instance was faced with to assist with the decision making. So this is a gentleman at the age of 58 who has worked making heavy-duty steel cables throughout his life, and due to the sort of labour-intensive nature of that work, it's had an effect on his hands. He's got problems with his hands, and doing the work is becoming increasingly difficult and painful. So this particular gentleman wanted to look at his options for retiring early. And one element just standing in the way of this decision was having gone through a divorce and got himself back on the property ladder. He has got a £35,000 mortgage left outstanding that ideally he could do with repaying that, so he hasn't got to file in monthly payments, thus making that more affordable. So we approach his final salary scheme and ask what his benefit options are, and that's down the left-hand side. His employer's scheme is going to offer him a tax-free lump sum of just under £66,000, and then a pension of just under £10,000 a year, which goes up each year in line with inflation. Now, of course, we do not know what future inflation is going to be. We know what historic inflation is. We know what the government's target is of 2% per annum. We can look at the rules of your pension schemes to see if there's any caps or, exactly what are the indexation rates of that scheme. To help this gentleman, we made a future assumption of 3% per annum. The piece of information missing from this is the transfer value, and the transfer value offered to this gentleman is that at the top, £570,000. Now, that is not his money. Not yet, at least, anyway. That is his pension scheme saying to this gentleman, if you are prepared to seek financial advice and you are prepared to sign a discharge form that waives your right to the benefits we're prepared to offer you, i.e. the £66,000 and the £10,000 a year, then this is how much money we will give you to take to a different pension scheme of your choice and do with it whatever you like. Under the new pension freedoms introduced in 2015, this person could effectively, if he wanted to, go and cash that £570,000 in. You wouldn't, because you'd lose a fortune of it in tax. But he has all the options then that you would have with a defined contribution scheme. You could use it for investment purposes, flexible access drawdown, you can secure an annuity with an insurance company, or any combination of the various other multitude of parameters that are available to you. We haven't got a mass amount of time to elaborate on all of that in this presentation. It is so vast, we'd probably need half an hour on this subject alone. I will go over the principles behind drawdown shortly. But just looking at the option of a level annuity, because an annuity with an insurance company, although annuity rates are really, really poor as a result of continued low interest rates, an annuity is a secure form of income, i.e. once the annuity is secured, it's guaranteed for life. There's no investment risks involved, and it's a good way to make a comparison with a final salary pension scheme because they are both secure forms of income. But upon transfer, the first thing to notice is the fact that 25% tax-free cash, well, 25% of 570,000 is £142,701. Now, the tax-free lump sum for this gentleman from his current pension scheme means, yes, I can pay my mortgage off, but I've only got 30 grand left over as a nest egg. Now, bear in mind this gentleman with having debt, he hasn't got any other savings. They were wiped out through the divorce. Any money he's been earning really has been allocated towards living because obviously he's living alone. He's only got his income to pay the bills, to pay the mortgage, etc., etc. However, the lump sum on transfer means, well, hang on a minute, I can clear my mortgage and I've got well over 100,000 quid left over. Then, of course, on the income, well, this gentleman doesn't need to provide for a spouse because he's not got a spouse. So within that transfer value, the costing for the spouse's benefit, he can use for him. And with an insurance company having gone through underwriting, bearing in mind this gentleman saying to us, you know, I'd like to get as much income and as much capital as I can day one of retirement, simply because as health is likely to deteriorate with age and nobody knows how long we're going to live, this gentleman wants to have more income to enjoy now whilst he's got the certainty of fitness, well-being, etc., etc. And as such, he is prepared to give up the future indexation increases with the final salary scheme and have a level pension which starts at 15,442 per annum, guaranteed for life. We also factor in some protections with that income. So as if he was to die early, the insurance company doesn't just keep all that money, and some of it can go to his children. But obviously, this particular gentleman is almost £80,000 day one tax-free cash better off, and over £5,000 per year income better off. If he were to get 3% per annum inflationary increases from the final salary scheme, it would be 17 years before the final salary scheme is paying out a similar level of income as to what he could have from the annuity today. And he'd be aged 97 by the time the higher income later in life, through those inflationary increases, has recovered all of the additional upfront tax-free cash he could have. I'll stop that one there and just leave this open to you as to what you would have decided to do. But you probably won't be surprised to know that this particular gentleman asked us to arrange a transfer. So where can we help you with all of this? Well, it's all about making informed decisions. You don't need the jargon. You just need to know really, what have I got? What's it going to give me? What will it give me later on? Am I invested appropriately? You know, what can I afford to do? What can't I afford to do? You just need it in straight talk because it is all about making fully informed decisions. That gentleman, if he wanted to, in the last slide, he could have invested that money if he wanted to as well. He didn't have to buy an annuity and arrange a secure income with an insurance company. And of course, there are added advantages of investing the money insofar as whatever's left in the pot when we die can be left to those we leave behind. And it does allow us some ability to manage the income more tax efficiently and bespoke it to your personal tax position. And of course, you've got the benefit of ad hoc withdrawals and so on and so on. So there's lots and lots of flexibilities around looking at the drawdown options. But of course, you've got investment risk with it. You've got to pay for advice too. There's going to be ongoing charges involved. So it's not right for everybody. But nonetheless, it could be right for some. And obviously, all we're here to do really is to help you understand all of your options in a way that you can understand. For those people who aren't old enough to retire, of course, if you're moving on to new employments, if you're leaving pensions behind with past employers, or you've got pensions, private pensions from, previous savings, you've really got to decide, what are you going to do with those going forward? Are you going to leave them where they are? Are you going to move them to a new employer? Are you going to reinvest them elsewhere? We've got to be looking at, what are the charges, what are the costs of that? Are you getting a decent return, and so on and so on? Do they need to be moved in the first place? At the end of the day, one of the starting places I always work from, which you can apply across a lot of things in life, is it broke? Yes, no. If it's broke, what's it going to cost to fix it? And secondly, is it worth fixing? That logic can be applied to lots of financial decisions. So moving on from retirement aspects, but sort of keeping a link between the two subject matters, what do these numbers mean? Well, if you've got good eyesight, I suppose, you could read the small print at the bottom of the screen and quickly work out these are insurance premiums from two different insurance companies for arranging £100,000 worth of life and critical illness cover for a 45-year-old non-smoking male over 20 years. Why is this relevant? Well, of course, usually for most people, whilst employed, you'd have a death in service benefit available, usually as a multiple of your salary, and you may also have other benefits available too, health benefits maybe, sick pay benefits, and so on and so on. Why is this relevant? Well, of course, if you are unfortunate to be subject to a redundancy situation, you are going to lose your those benefits upon leaving service. You may have similar benefits when you join a new employer. You may not. So if you are losing those benefits, it's just to draw attention to that, and that you may want to give consideration to arranging some alternative provisions to cover any shortfalls. Where else is this relevant? Well, of course, if you are paying £82 per month for something that you could be paying £65 per month for, well, surely that is worth us having a conversation to review what you are paying out for your various insurances and whether there could be cost savings to be made without losing any of the quality of the cover. So this is where we get into the subject of protecting you and your family. I'm a big believer in the fact that all the financial planning in the world is a wonderful thing to do. We'd all like to be putting money away for this, money away for that, and obviously where we can afford to do so, that's great. But if we don't protect the position, the first thing that's at risk if something goes wrong is all that hard work is going to be undermined. You may need to sell the house, you may need to downsize, you may need to spend your savings to live on. So setting aside a few pounds per month to make sure you've got adequate protection provisions in place is probably a very good and sensible thing to do. For the time being, let's keep this a little bit on the light side of things, should we say. What are the chances of? Well, let's suppose you do the lottery on a Saturday. What are the odds of winning that jackpot draw on a Saturday? Well, I can tell you that before they increased the number of balls, the odds were around 14 million to 1. Now, 1 in 45 million to 1. What about being struck by lightning? Well, I can tell you it's a lot less than that for certain. Apparently, in the UK, the odds of being struck by lightning are around 1 in 10 million. What about being in a fatal car accident at any point during the whole of your driving lifetime? What are the chances of that happening in the UK? Well, apparently, according to the source of the statistics given at the bottom of the slide there, 1 in 85. What about becoming critically ill and surviving that illness before state retirement age? Well, in the UK, that is currently around 1 in 5. 1 in 5 of us will suffer a major illness or disability and survive before we get to state pension age. And of course, the big 3 in the UK are heart disease, stroke and cancer. So usually at this point, I ask who's got their health provisions put in place appropriately and who's still buying lottery tickets on a Saturday. Let's have a look at the type of insurance products that people in the UK buy. As represented by this chart, I mean, we all know there are certain types of insurances that are mandatory to buy. For example, if you want to drive a car in the UK, you have to have car insurance, albeit, of course, there are some people who don't insure the car themselves. However, there are other insurances that, of course, aren't mandatory. I mean, when you look, for example, a lot of people have home insurance. It seems a bit of an oddity that lots of people are really concerned about the house burning down when you're not there, or somebody breaking in and stealing things, than people are protecting their own health and covering their own life. It seems a bit odd that possessions, material things, become more important than our own well-being and our own life. Of course, we all think we're invincible. It's never going to happen to us. But if you think about it, if you're unwell and you can't work, who is actually going to pay for your insurances? Who's going to cover your income? Have a think about how much income you currently earn at the minute and think about what that will amount to over the next 10 and 20 years. Where's that money going to come from if you're not able to work or not around to provide it? So some things to think about. It's about making sure that you and your family are adequately protected for what you need to be. And of course, where you've got things like mortgages and debts and so forth, and children to think about, looking after children, well, that's got to be taken seriously. You might be paying out for existing policies. You might already have insurance products. You might already be paying out for these things, but are they going to pay you out if you need them? Are you aware of the terms and conditions? Are you aware of any exclusions under the insurance products you're paying for? As independent advisors, we can help you get to grips with that, and we can have a look if there's any weaknesses or any areas of shortfall. At the end of the day, if you're paying out good money for insurance products and services, you want to have the confidence that if you need them, you are going to be paid out. I spoke earlier about making a will, and that I will emphasise again here. Vitally important to make sure that your family really is well protected by having a will in place. And if we think about the cost of life insurance, well, life insurance today doesn't cost a lot at all, simply because with medical science and technology moving on, you're more likely to suffer a major illness and survive it today than you are to actually die. So lastly, we're just going to look at some ways to reduce outgoings. And this isn't about living life as a misery, if you like. This is about just sensible budget planning. As you've probably gathered, there's all sorts of insurance products that people tend to buy. And reviewing them can obviously save money. If there's a way to save money without reducing the quality of cover you've got, then obviously that has to be a sensible thing to do. There's also utility bills you can review, and there's lots of automated switching services now available to help you save money on your utilities. And anything that technically is a fixed cost is potentially something you could save money on. What about paying off debt? We said earlier, if you've got a severance pay, why not use that to repay some of your debt? But bear in mind what I said earlier about the timing of it. If you can't pay things off, could you reduce them? Could you restructure them in some way? Could you take out a loan to pay off another loan? There's nothing wrong with doing that, but of course when people do take loans out, and possibly credit cards, but not to the same extent. We get a direct debit set up, we just carry on paying it. We don't realise that you could take out a loan and pay it off quicker, or save yourself some money by arranging a loan with a lower interest rate. Believe it or not, a £10,000 loan over 5 years, if your interest rate's 15% versus 7.5%, you'll pay over £2,200 more in interest alone. Do you pay the mortgage off? Well, that's a bit more contentious, I would say, given the fact that mortgage interest rates are very low. You might like the security of knowing you've got your house secured. You might not be comfortable with investment risks. But there is a weighing up thing to be done if you are comfortable with investment risk, because some may argue you could get a better return through investing than what you'd save in interest on your mortgage. And as I've already alluded to, if you can't pay things off, can you restructure them in some form, some way? By reviewing and suspending non-essential costs, what we're not talking of here is, like I say, living a miserable life, but it's just looking at your finances and, asking yourself questions, do I really need that? Do I really need to do that? It could be all sorts of things. It could be paying for a gym subscription where you're not really using it to its full potential, to the extent you're not really getting the value for money out of it. It could be magazine subscriptions that probably go unread. It could be all sorts of different things to do with life. So it's just about creating a sensible budget plan, really. And of course, if you are subject to a redundancy situation, looking at ways to keep the costs under control whilst you're finding new employment to stretch that severance payout as far as you can probably would be a sensible thing to do. You might be glad to know that this almost brings us to the end of this presentation. Granted, we've overrun the hour by a small margin, but I do hope that that has been informative and of use to you. Where do we go from here? Well, I explained earlier on that if you wish to engage with us further on a one-to-one basis and discuss your personal circumstances and needs, there is scope to do that. The way you organise that is, if you look to the right of this presentation, you'll see an interactive registration form. Please open that PDF, fill in the appropriate fields and email that back to us. We'll then get in touch with you to have a brief conversation about what it is specifically you want to talk about, so as we can make sure we arrange a most appropriate qualified consultant to get in touch with you and to discuss matters further. So what's this all going to cost you? Well, at an early stage in the process, it's impossible to know. That's why at the early stage we'll issue you with a document which explains how our proposition works and what possible costs could be. Because it's impossible to know what costs could be involved, that's why we offer the initial interactions at no cost and no obligation. We'll have a chat with you, as I say, to understand what you're hoping to get from us, what your needs are, etc. And we'll also ask you for information about your current financial position, including information on your existing provisions, life insurance, health insurance, investments, pensions, and so on. Don't worry if you don't know all the detail, because under most circumstances we'll need to get your consent to write to those providers to obtain the detail we need. And in any event, we have to have data that's less than 3 months old for regulatory purposes. The idea is we want to reach a point where we can come back to you armed with that information, having understood what you're wanting to get from us, to give it to you in understandable terms. That leads to one of three outcomes. Either you're in an appropriate place already and you don't really need anything further from us, you might need a little bit of signposting, and if that's the case, we'll give that. There is, of course, no cost incurred if that's all you need. The other two outcomes, well, we might identify something that's needing attention, but now may not necessarily be the most appropriate time to do that. We'll discuss the reasons with you why that is, and there could be a whole variety of reasons. And if that is the case, we'll seek your consent to contact you at a future point to discuss that matter further. If, however, we identify things that probably need addressing and need addressing now, we'll again discuss those things with you and explain how they could potentially benefit your current position. And we will, of course, at that stage have a clear understanding of what the likely costs are going to be. We'll then explain those costs to you in a clear, transparent way. And only if you wish to proceed any further from that point will a cost be incurred. You are, of course, under no obligation at that point and can obviously choose not to use or take up those services if you wish not to do so. We believe that is the only fair way of working with people, to make sure people have a clear understanding of what the costs and benefit are of using our services before you commit to them. I would, of course, like to thank you for taking time to listen to this presentation today. As I say, I do hope you found it to be informative. With being an online presentation, obviously we haven't got the interaction to ask questions now. However, if you do have any questions from the content you've seen or heard today, then do please feel free to get in touch on the email address at the bottom of the slide. That will come into our general email box, or of course there's our free phone number at the bottom of the slide too. And finally, a bit of housekeeping. We ask that you take the information that you've seen and heard today in the context it's intended for, i.e. it's there for information purposes only and does not constitute financial advice. With a subject so vast, it's nigh impossible within an hour's presentation to give a comprehensive list of all the options that may be available to you. Advice can only be provided after carrying out a full and thorough assessment of your current financial circumstances, your future plans, your future needs, your investment objectives, and so on. That leaves me to say thank you again for listening. I hope you enjoy the rest of your day, and for those who wish to get in touch with us for further information, we look forward to hearing from you.